Good morning, everybody. Mike Vacchi, Princetontrader.com, here with your Monday market webcast. All right, I was off last week, out with family, a little family time, chilling out, recharging to get back into what's going to be the fall. September, Labor Day is coming up, and then we're off and running through what is going to continue to be a very volatile 2020 for a number of reasons. So what we see here on the daily chart is you've got an upper Bollinger Band ride. You've seen some expansion of the bands. The bands are sitting about seven and change right now. But my problem is if you go back here, the bands are sitting at 5 and change. So it's not really, you haven't really seen the bands blow out. And the way that plays out from a price perspective is you just get this slow bleed to the upside. And people hate it, and they fight it, and they do it every day, and they pick tops, and they're wrong, and they just get dragged to the upside over and over and over again. Will this thing come in? Sure. It'll come in when it's good and ready. But I will say the same thing to you today that I was been saying to you all year long. For the past, since, this climb has been going on 4 months now. Going on 5. Until the bears can convert areas that matter on a closing basis and keep those areas as resistance on a multi-day basis, every dip will be a buy. We will continue to make higher highs, so on and so forth, as high as this thing wants to go. That's it. That's the bottom line. And that's what's playing out on this chart. So hourly wise, what we saw last week was a series of compression, expansion, compression, expansion, compression, little head fake to the downside, expansion to the upside, and right now it's testing the area of the hourly midband, which has proven to be pretty decent support. It's traded below it. They haven't been able to convert it to resistance. They certainly tried on Friday, unsuccessfully. Then they gave it up into the close. So look, you've got the hourly midband sitting at 13. You have the 9-day way down at 34.45. Okay, you get the new weekly pivot at 34.70. Pick an area that matters, bears. Pick one. Pick an area that matters. Close below it. Hold it for a couple of days. And we can talk about you not being complete and total trash every day, all day long. And that's, look, were we short at times in the last week? Absolutely. We were. And it went well. But it's a trade. But you can see the area in which these dips were bought and then higher highs get made. And, they top pick every time. They fight it every time. And every time, they just squeeze them to another higher high. Is this time going to be different? I don't know. Maybe, maybe not. We'll see. We'll talk about it as the week goes on. But just understand that whether, these situations in which you're short, when price starts to not work, you have to be flexible enough to not be ideological, not plant your flag and say, okay, this is it, we're going down. And say, okay, well, I made a little bit short. They're not getting it done. They're not converting this key area. We got to get long. So the majority of our handles last week were situations in which we were short. Bears couldn't convert, couldn't get it done. We end up in a long and then catch the price trend the rest of the day. So, you can be short in spots, understand it for the trade that it is, be flexible, make a change when you need to, take your profits where you find them, and be long. If you do that, then, you're not going to get hurt by the trend. Then you're not fighting price. You're just, exploring things in key areas. But for me right now, if you're short from up above, this thing needs to convert the hourly midband. And it needs to convert it on a closing basis. And then it can deal with a roundie at 3,500. We had a very quick 100 handles last week. We broke above 3,400 on Monday. we broke above 3,500 on Friday. That's a quick 100 handles. The mini will do that sometimes. Sometimes the S&P has no interest in trading in a certain 100 handle block. It just runs. And what we've seen now is, we've done another 24 and a half handles above it. The last risk marker I gave out Friday was at 34.89. And we traded at 35.24 Sunday night. I mean, that's a trending price. And it depends on what you want to see. If you tend to be short, you'll look at it and you'll say, well, it's overdone, it's this, that, or the other thing. Here's the problem with the overdone argument. Compression, expansion, compression, expansion. It's not parabolic. It's not parabolic. People want it to be parabolic. That's not parabolic. That's just climbing the hill. Slowly and slowly and slowly with all these little squeezes along the way. So be careful of how you characterize this market. Don't pigeonhole it as it's frothy, it's parabolic, it's this, that, or the other thing. This daily chart, you're not seeing gigantic range candles that are busting up above the third standard deviation Bollinger Band. You're not seeing that. We've seen that before, but we haven't seen that. You're just seeing a little bit of a climb. Seeing a little bit of a climb. Be short, take profits, respect it for what it is, but understand that when it stops being what you want it to be, you've got to be flexible. You've got to be flexible, or you're just going to get dragged to the next high. All right. Have a fantastic day. Take care. Trade them well. Be safe, be healthy. Talk to you tomorrow. Follow us over on Twitter, Instagram, and Snapchat at Princetontrader. Check us out on Facebook and join us for a free trial at www.princetontrader.com. Trade them well.